Hi, everyone. Welcome to Mortgage Monday. It's August 7th, 2023. And I'm glad to have everyone join our show on the SoFlo Real Estate Show with Athena. Last week, we spoke about whether or not it makes sense to buy down your interest rate. If you want to take a look at that video, it's right above, so go ahead and click on it. So are you struggling with buying a home in today's market with all of the media hype around foreclosures coming? And more importantly, is this going to be another housing bubble and another financial crisis? My name is Athena Barocas. I'm a top producer and award-winning realtor with Coldwell Banker here in sunny South Florida. I've been selling luxury homes for over 20 years, and I absolutely love it. On today's show, we're going to be talking about the 5 reasons why this is not 2008, why this is not another financial crisis. But even further, we are going to debunk the media myth that there is a plethora of homes coming onto the market that are foreclosures, because that's not the case either. So by the way, if you know someone who's struggling with buying a home, go ahead and share this video. It could be a great way for them to get right back into the market. So let's get to it. I'd like to welcome our guest speaker today, Danny Beydoun of FCM Home Loans. Danny, welcome. Glad to have you here.
Thank you. Thank you. Glad to be back.
Ah, nice. Hey, listen, it's Mortgage Monday. Let's go ahead and share what's going on with the 30-year mortgage and if there's anything we should know about this week in the financial market.
Well, as we know, the Fed's raised rates again, the prime rate of quarter 25 basis points, 0.25%. And just so the audience knows, the Fed prime rate and the mortgage rate are indirectly correlated or non-correlated for that matter, depending on perspective. So meaning the prime doesn't dictate the mortgage, but it goes hand in hand. 10-year, the mortgage rate is directly linked to the 10-year treasury. So that being said, current mortgage rates today on a 30-year fix is 7.49%. There's definitely an uptick since the Feds increased the rates. So there was some impact on it. And a 15-year mortgage is about 6.76% interest rate, and a 30-year jumbo mortgage is 7.31% interest rate. Again, this is just a general consensus. No one interest rate is going to match another person's. It's very unique to the individual, but that's a whole nother podcast in itself.
Absolutely. Thank you for that quick overview on the market. Rates have spiked. We've been watching them for the last 12, 13, 14 months, going between 6 and 7%. It is summer. It is August. So a spike is not unusual, but we do have some macroeconomic items taking place as well.
Yes.
Hey, so let's get to our topic because, I hear a lot of my audience, a lot of my buyers are saying, Athena, we want to buy, but isn't this going to be another housing bubble? We keep reading the headlines. And of course, you want to tell your clients, don't read the headlines, but
Exactly.
They do read the headlines. So I'm glad to have you here. And let's talk about why. Oh, thank you. Let's talk about why 2023 is not 2008. And let's start with the lender perspective on what you're seeing in the market that might be a little bit different.
Okay, you want to talk about first, 2008, what was, give a little background on what 2008 was before we dive into what 2023 is?
Yeah, absolutely. Let's start there. I think that would be interesting.
Yes. And I highly recommend for the audience to go watch a movie. It came out in 2010. It's called The Big Short. And there's one called War Dogs, but Big Short to me was, I would say about 95%, 98% spot on based upon the perspective of what Wall Street did, the regulators did, and why the collapse happened the way that it did. It's a phenomenal movie. But just a little bit of background because we got to unpack this. So back in 2008, around 2007, technically speaking, the U.S. subprime crisis was a multinational financial crisis that occurred between 2007, 2010 that contributed to the 07-08 global financial crisis. So the crisis led to a severe economic recession with millions of people losing their jobs. And remember that unemployment plays a significant factor in this equation too. And many businesses had went bankrupt as well. The U.S. government intervened in a series of measures to stabilize the financial system, including what, if you recall, that acronym TARP, which just stood for Troubled Asset Relief Program, and another one called ARRA. So subsequently, it triggered a large decline in the U.S. home prices. And after the collapse of the housing bubble, leading to the mortgage delinquencies, foreclosures, and the devaluation of the housing-related securities. So those declines in residential investments preceded the Great Recession, and then we were followed by a reduction in the household spending and business investments. So spending reductions were more significant in the area of combination of the high household debt and the larger housing pricing declines. So fast forward a little bit. So how does this work on the secondary market with Wall Street and all that good stuff? So the housing bubble preceded the crisis was financed something we call MBSs, mortgage-backed securities, and CDOs, what we call collateralized debt obligations, which initially offered higher interest rates, or i.e. better returns, than government securities. So like they say, Wall Street greed, right? Along with attractive risk ratings from rating agencies. So while the elements of the crisis first became more visible in 2007, there were several major institutions that had collapsed in September 2008. Everybody remember that one bank called Lehman Brothers? It was a couple $100 billion collapse, with that significant disruption in the flow of credit to the businesses and consumers and the onset of severe global recession. So there, again, we could go on and on. So the crisis had many moving parts. It wasn't just one thing to really point it at. But again, back to subprime lending and banks releasing it was a tsunami of underperforming homes, that devalued significantly out to the market. So those were a couple of the big significant factors of 2008. And so if at your lead, we could talk about what's happening fast forward at what point, whatever you're ready.
Yeah, absolutely. You brought up the movie The Big Short. I just want to stop for a moment because you had mentioned a couple of different factors, the MBS, the CDOs, the Wall Street, the rating companies, the consumers, the lending industry, the real estate industry. Yeah. It just couldn't keep up with itself. But the movie, if any of our audience really wants to understand,
it's awesome.
What happened in 2008 and what led up to 2008 from the perspective of these four individuals who uncover and narrate. Danny and I are going to do our best here, but that movie it just exemplifies exactly what took place. And, we're just not seeing that today. Thank goodness we're not seeing that today. But subprime lending was one of the major issues. And I remember, Danny, in real estate, the subprime lending and, the honeymoon rate for 5 years and how we all said, oh my goodness, when those loans recast, we're going to have an issue because those mortgages just weren't sustainable and we all knew what was going to come.
Yes. Sorry, go ahead.
No, go ahead.
No, I was saying one of the other, in lieu of, blaming Wall Street or blaming the regulators as well. And another problem was happening is in the appraisal side, appraisers, it became like the wild, wild west. Appraisers were now today, lenders are not allowed to even communicate with appraisers anymore. We all communicate through a fully surveilled portal. And that's how all communication goes. So there's no shady business going on. Back then, it was, hey, buddy, how are you? I'll meet you at the house. And, oh, by the way, they were just inflating prices to basically whatever made sense as long as their pocket was full. And that was another big factor from the retail side.
That is a big factor. And that was one of the items that were corrected with all of the legislature that came out afterwards. Absolutely. Absolutely. Let's get to it. Let's talk about the 5 major reasons. You and I talk about this. I talk about this with my clients, but really there's just 5 big differentiating items that really set 2023 apart from 2008. So I'd love for you to share those top 5 with us, Danny.
Yep, absolutely. So I can provide 5 potential data points that might differentiate the current real estate market, real estate economic slowdown from the 2008 crisis based on historical trends up to that point. So, on the we kind of talked about the mortgage delinquencies, the inventory levels, post 2008 banks flooded, and then fast forward. So today, where we're going with everything is, the housing bust was pretty clear. It incorporated distressed properties, sales, arms to the business. And, and not to kind of beat the dead horse, but we kind of resolved all that with today. And today, when you look at all the indexes, like the Case-Shiller index, the housing price, which basically is the housing price have increased for 3 consecutive months in a row. You look at the peak June 2022, slight decline in January 2023, immediate recovery was unbelievable. And then, as a matter of fact, the chief economist of Zillow, Skylar Olson, also quoted an article that the disappointed buyer asked, we're in a housing crash. There is not a space where home will become suddenly affordable. It's just not happening. It's a very, very different time right now. Employment levels are very low right now. So when you're examining employment rates and employment growth, it can also provide insight into the overall economic stability of a potential buyer. And if you want to fast forward, June 2023, Florida is up 2.6% in home value. In June 23, the nationwide is up a median is 3.6%. So Florida is very stable, doing very well. Low unemployment rate reduces an increase in foreclosures as well. Be mindful of that. And the average homeowner's balance sheets, there's a lot of equity in people's homes, much stronger today than it was 15 years ago. The typical homeowner today with a mortgage has stellar credit. And take it from me, I see it all the time. I see more 700 scores than ever before. A ton of home because of, in the wake of Google, World Wide Web, people have become more informed buyers. So people are becoming smart shoppers. So my job is not to really originate a loan anymore. It's to offer insight, education, and to cross-reference whatever there is that they're already researching and let them know how accurate or inaccurate that is. And then we share notes. That's basically where it's at today. Back to that, there's a ton of home equity in homes, like I mentioned a couple seconds ago. And here's the operative word. It's not the inflated home values that we experienced in pre-2008, whereas today, skyrocketing home values are simple economics, supply and demand. Low inventory has caused quite the frenzy in home purchases during the spring and summer months, which is peak season, in lieu of the high mortgage rates, which is an anomaly, which should have slowed down home sales. But since inventory is at a record low, and so many people are fear lost right now, and there's so much cash buyers, it's literally creating an absolutely unprecedented uptick in demand for homes, continually driving up the price of homes today. Again, an anomaly to say the least. And back to what I was saying as far as equity, and in the last 3 years, the average approximate equity is 34% gain from 3 years ago, and an average in some markets in excess of 50% in home equity appreciation. Again, it's nothing like 2007, 2008 because of all the equity and from non-inflated all the equity. Fixed rate mortgages locked in at a rate well below 5%. There's a lot of homeowners, particularly during COVID, that are locked in at very low interest rates. I mean, I can tell you probably a lot of people took advantage of the 15-year rates. I was locking people at 2%, 1.9%, 2.5%. It was literally people, anything below 3% is practically free money. Let's just say that. Free lending money. A new Redfin study said that 82.4% of all current homeowners are locked in at below a 5% mark. So again, the real estate market is very, very healthy and very, very stable. So
82% are locked in at that rate.
Yes. That's significant.
That is incredible. That's significant. And, we talked about low inventory. We've been talking about low inventory for months. We talked about low inventory before COVID. COVID peeled back the onion on the fact that we have low inventory. And now we look at inventory and people are saying, well, why aren't homes being on the market? Well, very good reason why homes aren't going on the market. One is that the interest rate that are locked in right now are so low.
Yes.
And people really don't have the incentive to want to take on a different financial, portfolio on their home. So they would rather do they would rather do home improvements. They would rather drive a little bit further for a commute. They're making adjustments in order to maintain that home and that, that free money. So
and you're talking about home improvements. I mean, I'll tell you what, I know several contractors, their business is booming since COVID.
You
booming.
can't book a try to book a
Oh,
bathroom remodeler. You are months out, months out. It is
I know
incredible.
contractors that are they're literally giving quotes at the highest end of premium pricing, hoping they would say no, and people and with a 2-year waiting list, and they said we'll wait and we'll accept
We'll
the
wait.
price.
We'll take the
It's
price, even though it's
it's
going to go up in
unbelievable.
2 years. Yes, it's
Unbelievable. Now,
unbelievable.
for the ones who are selling homes, and I'm sure you know, being on the front end, the real estate side, I always say it's very circumstantial. So timing and circumstance. What does that mean? The ones ready to sell, I would say in a bucket, the elders downsizing. They don't want their big home. They want to move into a condo. They want a ranch. They don't want all that space. They want to keep it simple, stupid, that kind of thing. KISS, keep it simple, stupid. Downsizing. Divorces. I mean, unfortunately, in the US, can't speak in other countries, 1 out of every 2 marriages end up in divorce. So because of that reason, there's a lot of homes now they have to split up the home. Somebody's moving out, somebody's buying a home, or they just sell it completely. Now they have to buy 2 new homes. Now you have a lot of younger millennials, smaller price points, but a lot of millennials are waking up and getting smart. Instead of renting, they're now calling me saying, "Hey, I don't know what to do, Danny. Can you help me out? I don't know what the first step is. Can you put me on a plan?" So I put them on this home buyer's journey plan, and they love it. So sometimes they're not ready right now. So it's more planting the seed and putting them on that plan, and they'll be ready in 3, 6 months, 9 months, or 1 year. But it's okay. But they're actually waking up to the whole, stay away from the rental. And, I always tell people, listen, you're going to pay a mortgage either way. Either if you're renting, you're paying somebody else's mortgage. And if you're owning, you're paying your own mortgage. Don't
Isn't it
worry about...
that goes back to our adage, do you want to make yourself wealthy or do you want to make somebody else wealthy? It's really that simple. You're paying
Bottom
a mortgage.
And in the mortgage world, you talk about, again, don't be shy about the rate, because rates go up and down. It's cyclical. You marry the mortgage and you date the rate. It's okay.
There you go. I like that one.
She comes
That's
and
a
goes.
cute one. She comes and
goes.
Oh my gosh. That's funny. But I think we go back to, really what's differentiating this market. And, there's ones that I, gravitate to is the home appreciation. That's a real appreciation. It's not the froth on the latte this time, right? It's real appreciation. Appraisers are going in and they are working hard to determine what is a fair market rate. Yes. And their analysis is spot on. I know I review the appraisal report. I know you review a appraisal report. And these are not easy appraisal reports. They are working hard to keep that, that fair market value in alignment with the market itself. The other one is, overall economic stability. The feds have been working very, diligently trying to control inflation, and everything they're doing is not really working. We're not having that low unemployment. Florida's at 2.6%, lower than the national average. We have another unique portion of Florida is we have so many buyers coming in from out of state and out of country. And so we just have such a strong demand, low inventory, prices are going up. We have a good economy in Florida right now. And most of the nation is experiencing something very similar. It's just not 2008. Lenders have to behave. Lenders have to behave. Consumers have to behave. It's just everything is regulated, and it's there's an oversight to it.
It is.
Yeah,
and I could tell you, like South Florida. Sorry to interrupt you. Florida, like I say, there's very few cities in the country or areas or regions in the country where even if a recession does happen or there's a soft crash or correction, whatever you want to call it, semantics. South Florida is one of those anomalies, like I would say parts of California, New York City, parts of Texas, Chicago. They bounce back faster than the rest of the country. And when they bounce back with a vengeance. When South Florida, when everything crashed, and it was like Armageddon for a couple of years. But after 2010, when things started turning around, from 2010, 2015, things went double and triple in some areas. I remember I was living down in South Beach at that time, at one of the high rises. And I remember, like, literally, if you bought something for 1.5 million at the time, let's say 2007, 2006, by 2015, you were selling it for anywhere from 2.7 to $3 million. So not only did it bounce back, but it was hitting record numbers. And that's South Florida for you.
It's true. It's true. It's a very unique market. I think there's only a few markets like that around the country that could come back with such vigor. But South Florida is definitely one of those. So as you look at the market today, Danny, do you have any trepidation, any fears that we're going to see anything that closely resembles another housing bubble or another financial crisis, or another plethora of homes coming on the market for foreclosure?
Honestly, and I don't have a crystal ball. I wish I did. I'd be, whole nother level. But since I don't, based upon all my research, and I do a lot of research all the time because I do a lot of video blogging and stuff like that. So I like to put a lot of good content out there to share with people. I just don't see it. Again, Case-Shiller, the leading indices, CoreLogic, the Federal Housing Agency, they've all already officially announced, based upon the performance of the real estate market in the last few months, that the recession decline in value for the areas that even experience a decline, which I know South Florida has not, it's done. They're basically saying on a national level, the real estate recession decline is done, even if applicable to your area. So that being said, it's just, yes, low inventory is putting a squeeze on things, but it's since now we have to adjust to the new normal. Now, since the affordability is squeezing people out, now there's less people competing for that less inventory. So it actually creates an uptick for those people. And now a lot of people are literally just taking money out of their home equity or money out of their 401ks, and they're doing cash offers. I'm seeing this is like a repeat of 2010 to 2015 in South Florida. There's a lot of cash offers that are happening today, which is unprecedented. It's just unbelievable. Because I tell people, and sorry, one more thing before I lose my train of thought, and I tell people, okay, so you're skittish about the interest rate, and as you know, sure, that's a value, that's a fair skittishness to have, but I tell them in 2-3 years, if you don't wait for the market to stabilize and the rates to go down according to your fear, uncertainty, and doubt, market stabilizing. But what's going to happen in 2 or 3 years? Rates are going to go down, but guess what's going to happen to the home prices? They're going to keep going up because from 2012 to 2022, home values at an average of almost doubled. So from 2022 to 2032, homes are likely going to double again. So you want to save $200-300 on your mortgage payment, but your home value is going to go up $30,000, $40,000, $50,000, and you're going to lose that value.
Yeah, no, it's true. It's true. It's a very difficult concept for people to understand.
Yes.
The wait game. I've been selling real estate for 20 years, right? Any buyer who tells me I'm going to wait, very rarely do they ever really buy the home that they ever wanted to buy, because it becomes unaffordable. And that wait game is just, I don't know, it's just not the right game. Get in the game and let the market appreciation really catapult you forward. So Danny, I just want to go recap real quickly. 2023 is not 2008. 5 different reasons that you had given. One is low delinquency on mortgage. The second is low inventory of homes. Third is home appreciation is still moving forward. We have overall economic stability on a macro overlook. And the big one, large equity position of homeowners. So these are 5 things that did not take place in 2008 that really speak to the strength of our housing market today. Danny, do you have any closing words?
Well, I can tell you what I'm seeing in Florida that agrees with the above statements and everything else that we discussed. Miami-Dade County single-family home median prices have went up 7.8% year over year in May 2023. increasing from an average of 575,000 to about 620. Miami single family median prices have risen for 138 consecutive months.
Ooh.
That's 11 and a half years, which is the longest running streak on record. South Florida continues to see a surge in domestic and international wealth migration as homebuyers from high tax, high density states relocate to purchase prime properties of $1 million and up in the area. The region's real estate market is unique due to the significant number of cash transactions, like I mentioned earlier, and the high rate of migration. So the housing market in South Florida, particularly Miami-Dade County and Broward, shows robust growth and resilience, and it's outperforming the pre-pandemic levels, according to April 23 statistics released by the Miami Association of Realtors and the MLS, the multi-listing system. The market's leading the nation in real estate appreciation. So again, there is no better time to buy than right now.
So the bottom line is, if you're thinking about buying a home, do not let the media hype scare you, make you wait, put you off. Contact Danny, contact myself, put a booking in. I have the link below. Book a consultation with us. We would love to talk to you not only about why this is a different market, but really talk to you about any aspect of the home buying process. Danny, thank you for being here. I love having you on our show, and I just hope you have a great week.
Thank you. It's always a pleasure, Athena. You rock, and I always love working with you. And any customer that works with you will have the best experience of their life. You're truly a rock star in your business.
Thank you, Danny. Right back at you. Bye, everyone. Have a good week. Bye.
Bye-bye.